Hi guys, welcome to this week's Intrinsic Market Value Update Report 2 for the Q3 earnings season. So for this week, we'll be focusing on the big technology stocks, namely Facebook or Meta platforms, Amazon, Apple, Microsoft, Google or Alphabet, and Netflix. Before we start, here's a quick disclaimer. Alright, let's get into the video. The first company we'll be looking at is Facebook or Meta platforms. They are the company that publicly has announced to the whole world that they will be leading the charge into the metaverse. Meta Platforms is the parent company of companies such as Instagram, WhatsApp, and Oculus VR. Looking at the free cash flow projection, I've actually used quite conservative growth rates for a company that is going to lead into the metaverse. So we can see right here that I've used 20%, 12%, and 6% as my growth rates, and combining it with a discount rate of about 8%, this is giving me a final intrinsic share value of about $460. And this is about a 25% discount from their current market price. And the reason for this large discount in the markets currently is because they have had a few scandals in recent months surrounding Meta Platforms or Facebook. Taking a look at Meta Platforms Facebook's chart, we can see that an area of support has begun to form at this level of about $317, where the stock price has bounced off once, twice, and 3 times. And this also looks like a third phase market of the consolidation phase. As we can see, the market is currently decreased and is currently ranging within this range here. And the moving averages are all very choppy. So we can see here there's a resistance, support, resistance, resistance, support, resistance. So if you would like to enter Facebook, even though it's already 25% discount, we can wait for it to possibly retrace to this level of support here, $317, so we can get an even better deal than a 25% discount. Moving on to our second stock, we have Amazon. Amazon is one of the largest e-commerce giants in the world, and they also are very successful in cloud computing with Amazon Web Services. Looking at Amazon's free cash flow projections, I've used growth rates of about 24%, 14%, and 8% for years 1 to 5, 6 to 10, and 11 to 20 respectively. With a discount rate of about 7.1%, I've generated a final intrinsic share value of about $4,040. And this is actually about a 15% discount from their current market price. So this 14% discount is a result of the Amazon share price actually moving sideways or in a range market throughout the whole year. And we can see more of this in the technical analysis in a bit. Looking at Amazon's technicals, it is definitely in a range market as well, as you can see the choppy moving averages cutting across the price action. So actually there's a strong level of support here currently at $3,180, where the stock price is bounced off once, twice, 3 times, and 4 times. There's a strong resistance level also of about $3,700 once, twice, and 3 times. So looking at this chart, if you would like for the price to retrace further to the $3,180 mark, that will be a very good entry point. However, in the past, I would say 1 month or so, it has begun to respect this 200 moving average. We can see here once and twice here, and now it's back a third time. So this might be a key area to look out for if we are trying to look to enter Amazon. However, if a bigger retracement is on the horizon, the next level of support past this 200 moving average will be this key level here of 3,180. Our third big tech stock is everyone's favorite consumer brand, Apple. Apple is currently the world's largest company, closing in on the $3 trillion market cap. They have been very successful in creating an ecosystem for their consumers with a wide variety of products across different categories. Looking at Apple's free cash flow projection, I've actually used similar growth rates of 20%, 12%, and 8%. And combining with a discount rate of about 8.5%, this has given me an intrinsic share value of about $198. When Apple hits past this mark, it will definitely be in the $3 trillion club by itself. As of last close, it's about 179.30, and this gives me a discount of about 9.6% compared to the intrinsic share value of Apple. Looking at Apple's technicals, we can see that currently the share price is way overstretched, as it's very far away from the 20 and 50 EMAs, the blue and the purple line. So there's currently an area of support here, which was a previous area of resistance, as you can see here. Now it's been supported, the price action right here, at about $157. So currently Apple is very overstretched, so I would not enter Apple anywhere near this point. Instead, I'll wait for it to make a pullback, probably to around this area of support to possibly add shares if I'm intending to dollar cost average. Our fourth stock for this report is Microsoft. Microsoft is the world's second largest company, just behind Apple. Their founder Bill Gates is also known as the father of the internet. Looking at Microsoft's free cash flow projection as well, I've used similar growth rates to Apple, and it is of 20%, 12% and 8% as mentioned previously, and with a discount rate of about 6.5%, Microsoft's final intrinsic value per share is about $357, and at the current market price of $334, this is actually a 7% discount from their intrinsic share value. Looking at Microsoft's technicals, we can see that the price also looks quite overstretched, even though it's within the 20 and 50 EMA. So just now I mentioned that it was overstretched because it's far away from the 20 and 50 EMA. However, in this case, I believe it's overstretched because the area of support or level we're looking at currently is not the 20 and 50 EMA like Apple, but we're looking at the 100 EMA, which is this orange line, because that's the area of support for Microsoft. So we can see, if I zoom out on the chart, we can see that the 100 EMA has been a strong level of support for Microsoft. Every time there's a retracement, it finds support at 100 EMA here. Once, twice, 3, 4, 5, 6, 7, 8 times. So if I'm looking to actually enter Microsoft, I'll actually look to enter around the 100 EMA point. And this would be about $312 currently. So I'll wait for Microsoft to retrace to this point before I consider adding any shares, even though it is currently trading at a discount, because I want the best deal, obviously. Our second to last stock is Alphabet. Alphabet currently owns the world's largest search engine, Google, as well as video platform, YouTube. For Google's free cash flow projection, I've actually used slightly more conservative growth rates according to the financial websites that I've looked at. So that is of 18%, 10% and 6% growth for years 1 to 5, 6 to 10 and 11 to 20 respectively. And combining this with a discount rate of about 7.2%, the final intrinsic share value generated is about $3,300. And that is an 11% discount from the current market price of about $2,950. Taking a look at Google's chart or Alphabet's chart, it might not be so clear as it looks a bit confusing currently. So actually there is an area of support here currently. Stock price has bounced off once and twice, and there was a previous level of resistance. This is not so clear, but it is a form of level that we can actually look at and pay attention to. The level that we should pay more attention to actually is the 50 EMA, which is this purple line. Once, twice. Barring this further retracement, which was the recent market retracement of about 5% to 6% about a couple of months ago, if we zoom out, we can see that for Google's chart, they actually respect this 50 EMA very well, this purple line. Once, twice, 3 times, 4 times and 5 times. So actually if I'm wanting to look into enter Google, it'll be anywhere around this 50 EMA point at this purple line here. Our last stock for this market update is Netflix. Netflix is the world's largest streaming subscription service platform, and they are behind one of the world's most famous shows ever, Squid Game. Looking at Netflix free cash flow projection, there's a cash flow growth rate of 25%, 15% and 10%. So I know that Netflix is way overvalued, so I've tried to be more as aggressive as possible to try to generate the highest intrinsic value per share as possible for Netflix. So using these high growth rates and a discount rate of 5.5%, I've actually generated a final intrinsic value per share of about $359. And even with these aggressive growth rates that I put in, Netflix is still trading at a 68.5% premium compared to their current market price of $605. So Netflix is way overvalued currently. Taking a look at Netflix chart, we can see that it has been on a very strong run in the past couple of months and actually has retraced over the past month or so because of the collapse in growth stocks. So at this black line here, this area of value, we can see that a previous resistance has potentially turned into an area of support for Netflix. However, as you can see from the chart, there's not many technicals that we can actually look at to time a perfect entry. And personally on my end, this is a very overvalued stock, as mentioned earlier, of 69% from the intrinsic share value. So this is actually not a stock that I'll look to invest in long term, But personally, if I would like to take a trade, this would be a pretty good trading opportunity right here at this level over here, with the target profit at the swing high and setting a stop loss 1 ATR from this level. That's all the stocks we have for this week's market update. Here's a quick summary table for you to take a quick look of all the stocks that we've mentioned in this video. Do let us know what stocks you'd like to see in the next market update. Don't forget to join our Telegram Signals channel in the description box down below. Please like, share and subscribe to our YouTube channel, and as always, may the markets be in your favour, and I'll catch you in the next one.